This is how to build a bulletproof crypto portfolio in 2026. Bitcoin dropped from $127,000 to $70,000, and most people panicked. However, for a select few, this was a phenomenal opportunity. The difference between these two groups of people, one had a plan, one had a prayer, have navigated multiple market cycles, slaying many bears and riding multiple bulls. What I'm sharing today isn't theory, it's an actual framework that we use. We're going to start by talking about the exact mistakes that destroy portfolios. Then we're going to understand where we are right now in the market cycle. Next, we can audit your current position, what you're holding, why you're holding it, and what you need to do straight away. Next, we're going to figure out your risk profile. Once we have that, we can start building the foundations of your portfolio. Then we're going to look at how you can get your portfolio to work for you and generate a yield. Then we're going to look at how you can rebalance and manage your position throughout the cycle. Lastly, we're going to go over the psychology it takes to help you deal with all possibilities the market could throw at you. All that together shows you exactly how we do this, the Cryptonary framework. If you're serious about building wealth in crypto, this is the video for you. Let's get to it. These are the mistakes that destroy crypto portfolios all over the world. This is what not to do. Mistake one, the 40 coin portfolio. I see this time and time again. Someone sends me their portfolio, they have 40 different tokens, they don't know why they're holding it, their allocations are messy, they think they're diversified, but in reality, they just hold a bunch of crap. They have all of these tokens, but they have no idea what they are or why they hold them. This is not diversification, this is confusion and dilution. If you had 20 tokens, each at $100, even if one 5x's, it's not going to give you a monumental return. The solution is concentrated conviction. Instead of holding 20 or 30 assets, hold 5 to 10 high conviction plays that actually have potential to outperform the market. That way, if one token does perform, it could easily offset the others that may lag. If you have a $10,000 portfolio split over 50 different tokens, that's $200 per position. Even if that token 5x's, it's barely getting you a return. Whereas if you have the same allocation across 5 assets and one of those performs, it can make a world of a difference. Every single token you hold should be in your portfolio for a reason. I challenge you this, open your portfolio right now. Look at every single token, I'm serious, pull it up. Now, I want you to tell me why you hold every single one of those tokens. If for any of them, the answer is I don't know, or something akin to that, then scrap it right away. The next question is now look at every single holding there and ask yourself, why do I hold the amount I'm holding? And if I was to go in now and buy the token at this price, would I keep holding it? I've got a strong feeling the answer for some of these things is going to be no idea. Mistake two, portfolio overlap. The amounts of people who come to me and they say, hey Adam, what do you think of my portfolio? And I see they hold Ethereum, Solana, BNB, AVAX, Sui, Aptos, and so on. I couldn't count how many times that happens every single week. Now, the intention there is right. You do need a level of diversification. And hey, if you look into each of these projects, they all have a good case. So I understand why on their own, people are going to hold these particular projects. However, it doesn't make sense to hold all of them. Why? The overlap. All of those projects are layer ones. They hit the same demographic, they serve the same purpose. That's not an actual portfolio. It's a bet on a particular sector within crypto. This type of diversification is cool, but it's not real. Because if the L1 sector doesn't perform, your portfolio won't perform. You're a lot better off being diversified across sectors. That way, if the L1 narrative underperforms, you're covered. Ultimately, the fix is to diversify across different sectors. Mistake three, never taking profit. I guarantee every single person watching this video has at one point or another said, I should have sold. Or they never sold at all and they wish they did. They round tripped. Now, This is very common, and I believe this is a passing of the guard. This is an initiation everyone must face if they're to get to crypto success. You've been there. You put $1,000 into a token, it's gone up to $15,000. The whole time, you're confident it's going to continue going up. Next thing you know, it's back at $800. You got nothing for it. You're not happy. And now you don't want to sell because you're down. That's not conviction. That's greed without a plan. Taking profits isn't weak. It's how you survive cycles and make generational wealth with crypto. The fix is before you go into any position, you should have an exit strategy laid out for all scenarios. Like, you literally have to decide when you plan to take profits, whether it performs, doesn't move, or goes down. Write the plan down. When your levels hit, you have to execute. There's no negotiating with yourself. These are not choices or decisions, they're rules. Mistake 4, chasing pumps. If you find out about a token and it's up 300% that week, you'll probably exit liquidity. The time to position in assets is when no one's talking about them. They say build in the bear, and the same goes for your portfolio. If everyone is screaming about an asset or a sector or a narrative, it probably already means you're late. That's one of the edges we've had at Cryptonary. We've managed to front run narratives before the mainstream caught on. So if you open up Twitter and see people talking about a token, get out. Now, I know what you're thinking. There are absolutely scenarios in which an asset has momentum, mainstream picks it up, and you don't want to get out because you think it's going a lot higher. And heck, maybe your thesis supports that. However, there needs to be a plan for profit taking, full stop. Next up, having no cash reserve. Being 100% allocated to the market is a no-go. It puts you in a position that when opportunities present themselves, your hands are tied. And inevitably, in a market like crypto, opportunities are abundant. And if you don't have cash to deploy, you're going to be stuck in your hands. What do? Do you sell positions to put into new positions? Do you scurry around for cash to try and buy? Or do you have a strategy? Do you have capital on hand ready to deploy when opportunities present themselves? Even worse, when the market tanks 30 or 40%, you're left feeling horrible. Your whole net worth is down and there's nothing you can do about it. On the other hand, if you were allocated but had cash on the side, you can take advantage of these dip buying opportunities. The best investors I know have capital on side, and that's a non-negotiable. And the next big mistake is not earning yield. I know lots of people who have 6, 7, and even 8-figure portfolios, but it doesn't do anything for them. Imagine purchasing real estate but not renting it out. It doesn't make sense. For sure, you hold the asset and you want the principal amount to increase. And any good investment should do this. However, why would you not be capitalizing along the way? If you bought property for investment reasons, why would you not rent it out and earn a yield along the way? That's what many people do in crypto. They get into assets, they hold them, and they're waiting for the value to go up, but they're not earning along the way. If you're not earning yield on your crypto, you're making a massive mistake. So now we've gone over the common mistakes that plague most people, and we know what not to do. If you're making any of these mistakes right now, don't worry. The next part of this video is about correcting all of them and building a good portfolio that does the opposite of all these mistakes. Step 1 is figuring out where we are and where we're going. When it comes to crypto, the number one thing that determines the market is macro. A macro essentially tells you whether we're risk on or risk off. This basically gauges how willing participants are to make investments into the market. If we're in a position where no one is willing to take risk and they want to pull their chips off the table, no matter how good of an investment you have, it's probably going to go down in value. Vice versa, if people are scared to take action, but you can see this happening and you get in, it's very likely you're front running everyone else. So you have to get a good understanding of the macro backdrop. You need to know when to accumulate and when to sell. Thankfully, me and the Cryptonary team put together a masterclass on this very subject, giving you our 2026 outlook, where we talk about exactly where we are right now, how we're looking to get involved in the market, when and where to risk on and off, and so much more. So go watch that video and circle back here. Now you have a better idea of where we are in the market cycle. And spoiler, if you haven't already watched the video, we're at the stage where we are looking to accumulate. We expect the market to perform in the second half of the year, which is exactly why we're making this video. So we know the landscape, but before you start buying, let's take a hard, honest look at your existing portfolio. And if you haven't got a portfolio yet, still watch, as it will better prepare you for the portfolio building section. If you already have a portfolio, let's open it up right now. Let's take a look at it together. What are you actually holding? Can you justify the reason behind it? Are there tokens there that are never coming back? Are they dead? When you look at the actual allocation, the total amount, do you think it's correctly weighted for the different assets you're holding? Are you holding too many assets? Are you not holding enough? Look, these are the type of questions you have to answer before you can do anything else. Here's a brutal exercise. Look at every single token you hold and ask yourself, if I didn't hold this token, would I go and buy it right now at this current price? If the answer is no, then you should strongly consider cutting it. You need to identify dead positions. Some tokens are never coming back. If someone told you to buy something in 2017 and it hit an all-time high and now it's down 80%, I get the impulse to say, I'll just wait for it to go back up. But a lot of these tokens are never going to come back. And you're probably better off cutting them now, taking that capital and look to redeploy it in assets that have potential. Selling at a loss sounds bad, but it's not failure. Failure would be holding on to it. Holding on to a dead position is not failure. Not being able to accept it as a failure is. Next, you got to look for concentration and overlap. As we said when looking at the mistakes, do you hold too many assets in the same sector? Because if you do, you don't need to hold all of them. Instead of picking 5 L1 tokens to invest in, pick 2. Instead of holding 15 meme coins, pick 3. You don't need to overexpose yourself to a particular sector. How many tokens are you holding, and do you know why? If you don't have a reason to hold something, why are you holding it? Do your allocations make sense? You probably have goals you want to hit. Does your portfolio actually have the potential to hit your goals? The amount of people who come to me and say they want to 10x their portfolio, but they're not willing to take any risk, you'd be surprised. It's a lot of damn people. Your portfolio has to have the potential to hit your goals, or you're going to rush and make decisions. If you're completely new to the game and you don't have a portfolio yet, that's actually a phenomenal opportunity because you can skip past the initial auditing and just go fresh into it. But there are key questions for you to consider. Number 1, are you looking to make a lump sum investment? How much capital do you have? How much are you willing to risk? And what are you looking to do? Are you going to put the whole thing in now? Do you want a dollar cost average in a certain amount every month? Do you want to buy at certain levels? That's the one I'd advocate for. It all depends on your goals and what you're looking to accomplish. So at this point, you're one of 2 people. You're the guy who's already in the market, and now you've sat down, you've taken a look at your portfolio, and you decide to make some cuts, for whatever reason that is. Whether you don't believe in the token, you accept it's dead, or you understand there's too much overlap with other assets in the same sector, or you're person B, who's new to the market, and you don't hold anything yet, but you now have a plan for how you're looking to deploy, whether that be lump sum or dollar cost averaging. Now, let's move on to phase 2, what I believe to be the most important factor in all of portfolio construction. And one of the number 1 things we at Cryptonary use to work with our clients to outperform the market. Define your risk profile. Who are you as an investor? Be honest with yourself. Ask yourself the hard questions. How much of your total net worth is in crypto? How do you react when the market pulls down 30%? If a position you're in 2x's overnight, what do? Do you cash out? Do you let it run? Do you panic? Do you smile? What's your reaction? What's your time horizon? Are you here for 6 months? Or are you here for 10 years? Because it makes a massive difference when making decisions. Do you have an income outside of crypto? Or are you using this capital to live your life? Have you lost significant money in crypto before? And how did it make you feel? Do you have responsibilities outside of crypto? Do you have a family you're responsible for? Do you have health issues you need to take care of? If you don't have the answers to these questions written down, you will make emotional decisions. And when that pressure hits, you will make some very expensive, costly decisions. So the solution is to create a rule book for yourself. You need to ask yourself, what will I do if I get a 2x overnight? What will I do if the market pulls back 30%? Do I have enough capital outside of crypto? What is my risk mitigation strategy? Will I add to a losing position or no? Will I ever buy into a token if it's 2x overnight? How long will I give myself before I FOMO into a pick? And these things are not decisions, and this is not about making decisions or making choices. Those are recipes for disaster. You need to understand yourself and your own psychology, and you have to create a system, a set of rules you will follow no matter what. Look, we've all been there. Think about your personal life. A friend comes and asks you to go out late at night. You don't want to, you know you're gonna sleep late, you're gonna wake up tired, so you say, no, I don't really feel like it, it's not my thing, but he pushes you and he pressures you anyway. And you think, why not? Let's just do it. It doesn't matter, it'll be okay. I'll get home early, I won't stay out late, and I'll be fine. And you break that, and you come back, you sleep late, the next morning you're exhausted, you make bad decisions all day. You can't let that happen. You need rules. These are non-negotiables. If a friend comes and asks you to come out late at night, you say, I do not go out on weekdays. That's just not who I am. It's got to be part of your identity. That's the difference between a choice and a rule. You need rules. These are things like, I will keep X percentage of cash on side at all times. This is, I will always take profit at a 2x. This is, I will never buy into an asset if I can't justify the decision with other people. The maximum drawdown I will tolerate in a market is X before I pull out. Build out these personal rules and immediately you'll see a massive difference when building a portfolio. All of this comes together to help you figure out your risk profile, because risk profile is everything. Me and you, we might feel very differently towards the market, and we can be in the same positions, but you might handle them better or worse than me. Maybe I can stomach a 50% drawdown and you can't. The difference is not the drawdown. I might be comfortable with it, you might not be. That lack of comfort may push you to make terrible decisions. So at this stage, you know the most common mistakes that destroy portfolios. You understand where we are in the market cycle. You know it's time to start allocating. You've taken a real strong look at your current portfolio and you know immediately what needs to change. Or you're sitting on fresh capital and now you're looking to deploy. And now you've just done the most important part. You've gotten a better idea of the man in the mirror. Who are you? What are your risk preferences? And you've set some rules to help you navigate the market. Now we've gone through the behavioral stage of portfolio construction. Now it's time to get to the practical. Every portfolio is held up by 4 pillars. It grows, it generates yield, it has the ability to capture maximum upside while limiting downside, and keeps cash on hand to capitalize on opportunities. Miss any one of these things and you have an incomplete portfolio. Let me show you how you can cover all 4 of these bases. These are your blue chips. Think of these as the forever hold. If you got hit by a bus and you were to wake up a year from now, these are the assets you wouldn't mind holding if you got hit by a bus. They are the foundation. They set you up to survive bears and ride bulls. These are the assets that lead rallies also. This is the part of your portfolio that allows you to sleep at night. In a bull market, people dismiss these things, and I understand why. There seems to be massive opportunity out there. Why would you want something like Bitcoin or Ethereum? They're probably not going to 5x. We'd be lucky if they 2x. So people dismiss them. But without them, you're not really in crypto. In bull markets, people ignore them. They're not excited by a 40% return. 5x, we're not interested, is something I hear quite a lot. But everyone needs exposure to assets like Bitcoin and Ethereum. And if you don't, you need to. Okay, next up we have sector and narrative plays. Money flows where attention goes. And in crypto, it's all about staying 1 or 2 steps ahead of everyone else if you want to make the most money possible. This means tapping into narrative and trends before everyone else hears about them. Right now, some of the trending narratives are meme coins, AI sector, RWAs, and a few others. Get exposure to some of the key sectors within crypto at the mid-cap level. These are things like Hype for DeFi. These are things like Doge for meme coins. These are things like Monero for privacy. So now with our blue chips like Bitcoin and Ethereum that make up our foundation, then the middle of our pyramid, assets like Hype and Doge, which cover our bases in different sectors. And now onto the third part. This is high risk, high reward. These are high conviction, asymmetric bets. Smaller positions, earlier stage projects, emerging narratives. They're not random. Each one should have a clear thesis and potential to 10, 20, or even 50x. You probably don't want to have more than 1 to 3% exposure in some of these picks. But if you're right, even one successful 50x pick could transform a portfolio. And you'd be surprised. It actually is quite common in crypto to get some of these returns. We at Cryptonary alone got 4 meme coins in the last 2 years that 200x plus. And we caught Hype pre-airdrop, which went in 20x within 12 months. The next pillar, and it's a non-negotiable, is cash. So in this case, USDC or USDT. You need cash on hand to capitalize on opportunities. Always keep a percentage in cash for dip buying opportunities. When Bitcoin dropped from 127K to 70K, lots of people were panicked. The ones who stayed calm were the ones who could buy in lower. So instead of crying about their position going down, they were excited because they were able to buy in at better prices. Now at the same time, you don't want to leave your cash idle. You want to be putting it to work. That's the next step, isn't it? That's yield generation. There are protocols out there in DeFi which help you comfortably get 5 to 10% on stablecoins. You can use cash to provide liquidity, farm airdrops, put into the lending market and a yield. There's so many opportunities for you to use your cash while you're waiting for opportunities that it becomes an absolute no-brainer. Cash is not optionality, it's insurance in crypto. So now you hold some blue chips like Bitcoin and Ethereum. You have select altcoins that are mid-cap market size, but tap into different sectors and narratives. Now you have some very high risk, high reward plays such as meme coins and RWA tokens, which can give you massive outside returns. And you have cash on side that's working for you, generating you a yield. That's the foundation of every portfolio. But you also now need to know how and when to exit. You need a strategy for getting out. It doesn't matter how much money you make if you never sell. People cry to me all the time about unrealized gains, which basically means they went in, they built a portfolio. It went up massively and now it's down and they have nothing to show for it. Every position needs a clear entry and exit plan. You need to define all of these things before you enter a position. What price are you getting into it at? Where do you plan to take profits? What's your invalidation if your thesis is incorrect? And by doing these 3 things, you can be a lot more confident in your positions because you're covered for all bases. For every position, you need to know 3 things: your entry plan, your profit-taking plan, and your exit plan. This typically comes down to the levels you're looking to buy at, which time frames. This talks about the levels you're looking to sell and take a profit at, and what needs to happen for you to change your mind. What would invalidate your thesis? As soon as you can do these things, you'll feel a lot more comfortable in individual positions. If I'm to talk about some quick allocations, obviously I mentioned it depends on someone's risk profile. But for most people, I would say 20 to 30% of their capital should be in assets like Bitcoin. I would say another 20 to 30% should be in stable coins. I would say another 20 to 30% in select altcoins, which are diversified across sector. And then I would have a small percentage, 5 to 10%, in assets like meme coins, which are very risky, but have massive upside. Next, let's move on to making your money work for you. Like I said earlier, it doesn't matter how much money you have if you're not doing anything with it. It's like being a real estate investor, never actually renting out your properties. You're just missing out on a massive opportunity. And heck, who cares if you have $10 million in crypto if it's not generating you anything? How can you quit your job? How can you pay for your lifestyle? It doesn't make sense. You need to. So let's go over a few different ways you can get your money to work for you. The first thing you've probably already heard of is staking. Now there are a few different types, but in short, a lot of these crypto protocols need you to use their native token, such as ETH on Ethereum or Sol on Solana, for them to validate and secure the network. So what happens is you can put your tokens up and they can be used to secure the network. In return, you can get 5 to 10% on assets like Ethereum and Solana. Next is the lending market. So in traditional finance, when people need money, they go to a bank and take a loan. In crypto, people use DeFi. And instead of going to a bank, a centralized entity, they go to each other. So you, in a sense, can act like a bank. You can go to some DeFi protocols and you can supply liquidity, such as USDC or Solana or something like that. And you can basically say, hey, I'm willing to borrow my assets to someone, but I want to earn a premium on it. And that's very common in crypto. And you can quite comfortably get from 5 to 15% a year in the lending market. Next, we have liquidity provision. Now, we already released a 40-minute masterclass on how concentrated liquidity pools work. I'm not going to go into detail here, but I highly encourage you to watch the video. And it's very possible to earn 50, 80, or even 100% a year on your crypto with these methods. Of course, with that, higher returns equal higher risk. It's a very sensitive subject and must be handled with care. And of course, we can't forget about airdrop opportunities. We at Cryptonary are being very fortunate with airdrops. It's one of our main offerings. We go out, we find emerging projects that are likely to drop a token. We help our users farm them. So when they do drop tokens, our users are rewarded. We've had many wins. We had both Hype and Jito, which generated 5-figure returns for members, which also went on to do very, very well in the markets. This is especially powerful for smaller portfolios, and I believe pretty much everyone, if they have the time, should keep a small amount of capital on side for consistent airdrop farming. The goal with these different methods is to yield stack. Use a bit of concentrated liquidity, use some airdrop farming, do some staking, do some lending, and create a machine that consistently brings you enough capital to do one of two things, if not both. Put money into the market to increase your holdings. Number two, pay for your life. And in most cases, do both of these things. Get your money working for you. Now look, we're at the stage where we've pretty much built a phenomenal portfolio. You have your core holdings, such as Bitcoin and Ethereum. You've got your mid-risk plays, such as Hype, Jupe, Doge, etc. They tap into different narratives and sectors. They've been around long enough where you can have some confidence, but they have enough upside because not everyone is aware. Then you've got your very high-risk plays like meme coins. These things have massive potential, and when liquidity hits and risk tolerance increases, these things can go parabolic. You don't want too much in them because it's a very fickle market, but you'd be making a massive mistake if you didn't hold any. And then of course, we have cash on side that's consistently helping us earn on our crypto. We've got a bit in liquidity pools, a bit in the lending market, and hey, if you've got some spare time, you're farming airdrops. So you've pretty much got a phenomenal portfolio, and at this stage, I think you're ready to go. And it's important you are actively rebalancing and managing your portfolio. You've probably heard a lot of people say set and forget, buy and leave. And for sure, sometimes in traditional markets, these things work. Because hey, on the S&P 500, for example, there's auto rebalancing anyway. These things are happening. You're not deciding what they're buying and selling as a company. You're not deciding what's in the index and what gets taken out of it. You're not choosing the weight of each company. You're just holding it. But what's happening beneath the surface is a lot of activity. There's companies coming in, companies moving out, a rebalancing the amount in particular companies. So it's not the same in crypto. You actually have to take a more hands-on approach to the market, consistently rebalancing and rotating if you want to stay ahead. You've got to think about your portfolio like a living, breathing thing. You have to nurture it. When a position moves 20%, your whole allocation just got thrown off. You need to rebalance. Now, there's no set way on how you have to rebalance. You might take a monthly approach. You might want to be dynamic when certain levels are hit. You may put something in your calendar and do it even more actively. However, as your portfolio grows, you should have a plan for taking profits, reallocating, changing position, and look. The more you have to lose. And over time, your tolerances will change as an investor, and you can go back to the drawing board and ask yourself once again those risk profiling questions to help put you in a position where you're confident when navigating the market. Maybe you have a rule, such as no single altcoin can be more than 10% of your portfolio. If that thing 2x's, you hold a little too much of it. Don't let the FOMO creep in. Reposition. Right? Doesn't mean you necessarily have to buy into another asset. keep extra cash on hand. Let it work for you. It's one of the hardest things to do in crypto, the rebalancing effect, but it is the most important. You also perhaps need to rebalance when theses change, when the market environment changes, when new information becomes accessible to you, if macro shifts, if a life event alters your risk appetite. If your thesis breaks, you need to act. You don't wait for a calendar. If something changes, you need to act. You cannot wait in this market. A short rotation framework that we have at Cryptonary is typically looking at things from a risk on, risk off perspective. This is our rotation framework and how we see things as the cycle matures. Over time, when capital first comes in, it comes into majors like Bitcoin and Ethereum. Naturally, you see rotations down the risk curve into the large altcoins and eventually all the way risk on into the small caps and assets like meme coins as people become more confident. Naturally then, you start to see people rotate those profits back into the majors, and inevitably, what goes up must come down, right? So it's not all sunshine and rainbows. Eventually, macro backdrop changes and you see a rotation out of the majors into cash positions. And I know it doesn't sound nice, I know it sucks, but unless you're willing to look at the market from that perspective, and unless you're willing to rotate, you are going to end up stuck in one of these phases for too long. The key is to follow these phases as accurately as possible. Now look, everything we've gone over today is very clear, very logical. I doubt there are many things in this video you disagree with, but that doesn't mean it's not bloody hard. It's very, very difficult to do what we spoke about. Sometimes it's a mental game. You know, you can have the perfect logical framework, but that doesn't account for emotions and life events. Then no one can actually control the market. No matter where all the data points, things do change. You have to be adaptable. You can't stop fear from overtaking in a risky environment. And you can't be surprised when you end up feeling the need to FOMO in to an opportunity. I've been through countless 50% runs and drawdowns, and I understand the difficulty. I've seen tens of thousands of investors consistently make mistakes. Like that of which we spoke about today, they still make mistakes. So here are a few practical rules I'm going to share with you that should help you make better decisions for your portfolio. One is the 48-hour rule. If you want to buy something that you heard about from a friend or a stranger, take at least 48 hours to research it before jumping in. Now, of course, you can say opportunity is lost in those 48 hours, but hey, that's also where you secure yourself. So it might be a catch-22, but it's one I believe is worth making. Next up, a decision journal. Every single time you make a decision, write it down. Share what was in your mind. Maybe record a video and talk to the camera yourself and say, okay, this is what I'm doing. This is why I'm doing it. This is how I feel. And go back and see what you said in those videos. Maybe things didn't work out. If you go back and you look at what you said in the first place, then maybe you'll feel a lot better about an outcome. As they say, don't always judge a decision off the outcome. Judge it by the reasoning of the decision. Another one, and this one's very difficult, is put a limit to the number of times you check your portfolio. Checking your portfolio every 20 minutes is going to do nothing but burn you out. Very rarely is there a need to check your portfolio and make a change. You're not a trader. You're here for the long term. And long term in some cases in crypto even means a month or two at a time. So set a time or frequency that you check your portfolio and follow this rule. It might be difficult in the beginning, but do your best. Whether that be once a week, once a month, once a day, whatever works best for you, depending on your strategy, stick to it. Also, become part of a community, have some accountability. This is not a one-man job. Like they say, if you want to move fast, go alone. You want to go far, move together. And in crypto, the game is to move far. Surround yourself with people with similar missions and similar goals and hold each other accountable. We are smarter together. The way at Cryptonary we look at things is like a hive mind. Right? It's more than just one person. 10,000 minds are better than one. And that holds very, very true when it comes to the investing game. Now, I've given you the framework to think about, but let me show you how we at Cryptonary implement it with all of our members. After 9 years in the game and multiple cycles, undoubtedly, the key first is to understand one's goals and ambitions. If you don't have your goals written down, you're never going to accomplish them. And then you need to make sure they're actually realistic. We're setting goals, we're not setting dreams, right? You're not going to 500,000 extra portfolio, are you? right? Don't set yourself up for failure. Set goals that you can actually accomplish. Next up, define your risk appetite. Go download a large list of questions to help you get a better idea of what's happening in your mind. And don't judge yourself. It's okay if you get under pressure quite quickly. It's okay if you stress. There are scenarios in which this is a safety mechanism. But understand your risk profile, and then the key is matching your goals with your risk profile, and then using that to build a foundational portfolio which ticks off everything we talked about. Has some cash, has majors, select alts across sectors, has a few high conviction, high reward, high risk, asymmetric plays. And then get your money working for you. And remember, everything starts top down. It all comes down to macro. So depending on where we are in the cycle, consistently look to rebalance, trim, add to positions, and don't be afraid to take profits. For every token you buy, understand why. Do not put yourself in a position where you're holding things with no reasoning. That's where you're going to get shaky. That's when you'll lose confidence. That's where your conviction wanes, because you don't know what you're holding. Then position based off your risk type. Position sizes should be based off conviction and risk reward. High conviction, 10, 20%. Low conviction, 1, 2% at the most. This active management week to week. You cannot just sit and do nothing. This is a volatile market and opportunities are abundant, but you have to stay active. Or at least get a team who can be active for you. I'll be transparent, we don't get everything right. We haven't always sold the top and bought the bottom. We've said we think it's going up and it goes down, and vice versa. We've invested in tokens that got invalidated after a few months, but we are putting the work in every single day, and that's what we look to give our members in Cryptonary Pro time and time again. And that's how we've managed to pull together 300,000 investors who trust us every single day with our research and analysis. Let's conclude this by recapping everything we went over. 1, the mistakes people make that destroy their portfolios. Number 2, the current market and where we're positioned right now. Number 3, we audited your current portfolio, knowing what to get rid of and what to keep. Next, we defined your risk profile and your behavioral patterns. After that, we looked at the foundations of a portfolio and the 4 layers it must cover. Then we looked at how we're going to put your capital to work so your money actually works for you. And then we understood the importance and theory behind consistent rebalance. I've given you the framework. Now it's up to you to implement. And look, there are 3 ways about this. You can do it yourself, you can do it with us, or we'll do it for you. If you want to do this on your own, great, good luck. Save this video, refer back to it, and build out a portfolio if you haven't got one, or audit your existing and then start working on a new one. If you want help, if you want to see the exact portfolio holdings we have, if you want our top picks, if you want to see where we think we are in the market cycle, if you want to know when we're making rotations, then go and check out Cryptonary Pro. And for those with 200K plus portfolios, a lot more skin in the game, who want a more personalized service, we recently launched Inner Circle. It's capped at 30 members. We're only taking a few extra people every single month. But if that's something you're looking for, then click the link below and learn more. And hey, drop a comment below. Let me know what you thought of the video. Let me know what you want us to cover next, and subscribe if you haven't. This is the type of content we're looking to put out every single week. Not hype, not shilling, real frameworks for building real wealth. I'll see you in the next one.